Welcome to my video. My name is Gabriel. I'm a med student. I live in Denmark and I like to trade as a hobby. I've gotten payouts before from my funded futures and I'm somewhat of a profitable trader. So yeah, I'm gonna start making videos about trading on this channel, and I'd like to start it off by presenting a model, a analysis of a type of model that we call the risk of peak-to-valley drawdown percentage. So I've observed in the trading market or in the trading space, video space, that a lot of people uh, know how to basically backtest. So the first step in knowing or finding out if you're profitable is finding out if your strategy even is profitable, and you can only do that by backtesting objectively. Not only is backtesting very advisable, I'd also go as far as to say these types of models, as the risk of peak to valley drawdown, are extremely essential and important, as well as the risk of ruin model. Right now I have the risk of peak to valley drawdown because I trade prop firms. If you traded live accounts, I'd prefer using the risk of ruin analysis instead. And the reason why I'm making this video is because a lot of people, they know how to backtest, but they just don't know what to do with the backtest. I mean, you gotta backtest, journal your trades, and use these kind of models to predict the percentage or the risk or probabilities of you breaching your accounts or losing the accounts, and so on and so forth. So these types of analysis are extremely important in the trading world. Trading is very interesting. It's like being the house in a casino, but you never know when you stop being the house, because you never know when markets change and strategies stop functioning, right? Anyways, let's get into the model. So yeah, the model is basically the risk of peak to valley drawdown is basically the percentage of you being the peak hitting the trailing drawdown of, in this case, $2,500. So I've made it for my case. I use my funded futures. I've bought three 50K accounts after I breached my past account earlier this year. So I have now just bought three 50K accounts, and the drawdown is $2,500, right? And I have backtested this strategy for 1 year, or I have not done it, but it's been done by a guy named Bernardo Lafay. I'm gonna put his account in the what's it called, the description down below. So yeah, the risk of peak to valley drawdown, I just defined the definition, and then I've basically it depends on two factors. You've got, first of all, the amount of trades that you use, or the amount of trades that you do, and the amount of contracts that you do. Not only that, it's of course also based on the win rate, the risk to reward, the stop loss, and the take profit, and of course the size of the account and the drawdown allowed. So I'd recommend, of course, backtest your strategy for at least a year, and when you have those values and data, then you can start playing around with these values. So what this model basically tells us is that, for example, if I trade with my strategy with one micro contract, one MNQ contract, the chance of being stopped out after 25 trades is 0%, and the chance of being stopped out after 200 trades is 1%. This is based on the expected value and basically the expected value and the chance of us hitting the amount of trades for it to be a drawdown. So for example, in 25 trades, if I trade one MNQ, I have to lose every single trade with a 42% win rate. So what's the question is, this is probability within probability. What's the chance with a 42% win rate of losing 25 times in a row? And that chance is 0%. Now, if we do 5 micro contracts, I'm basically risking $500 per trade, which means that now we are checking what's the chance of losing 5 times in a row after 25 trades. And that chance, so the probability within the probability, is 42.2%. So this model basically gives me a very good understanding of how much I should risk in terms of contracts. And that's why the model is so beautiful. Right here in this case, for my case, I'm going to trade 5 micros. And you're going to tell me, well, you're crazy. The reason I'm going to trade 5 micros is because I'm still in the passing stages. So I have to basically pass the accounts before I can use them. So what I'm going to do is I'm going to run what's it called? I'm going to run 5 micros because I think basically 3 wins in a row and I've passed this challenge, right? So I believe in my theory is when 25 trades have gone through, my chance of hitting 3 wins and passing the account are better than my chance of hitting 5 losses in a row. That's basically my theory. But the chance is still 42.20% of ruin. So if I, for example, hit the amount of trades, 25 trades, I'm going to look at myself and do a reevaluation, right? So I'm going to think, all right, fuck it, stop trading, right? Or lower the risk. Of course, when I've passed these 3 accounts, which I'm going to be updating on my account, I'm going to do a journal analysis of all my trades and so on and so forth. I'm going to, of course, lower the risk. So I'm going to maybe run 2 micros or 3 micros per account. I think I'm going to do 2 accounts with 2 micros and then the third one with 3 micros, running a little higher risk. And the reason is, in theory, yes, I have 200 trades, but the theory is, or my hypothesis is that when I reach 200 trades, the markets have changed so much that these statistic and this 42% win rate has become irrelevant to the data that will be available in that period of time. So 200 trades later, right? So I would like to reach somewhat 50 to 100 trades with this strategy. So that's why I'd probably argue to run maybe 2 or maybe 3 micros, 2 accounts with 3 micros, and then 1 account with 2 micros, right? So yeah, that's basically what I wanted to show today. And the what you need to take with you is risk management is extremely important. Just backtesting a strategy and having a 42% win rate or having a profitable strategy in the long run is not enough for this trading world. You also want to take your data and basically use it to create analysis, analyze your data and use it to basically predict your risk. So this is essentially the essence of core risk management in terms of prop firm trading. So yeah, this was just a little video. I hope you enjoyed the video. If you guys enjoyed the video and find it useful for your trading or your trading, just like the video and drop a message in the what's it called? Basically, just drop a message if you want to. Anyways, have a good day. See you.